As Billy Joel once sang, you can pay Uncle Sam with the overtime. But that might not be quite the case under the One Big Beautiful Bill Act, or OBBBA, which promises no tax on overtime. But is that really the case? And how does this affect your tax return? I'm a tax geek, and here is the new overtime deduction under the OBBBA, oversimplified. The no tax on overtime provision of the OBBBA is actually a tax deduction of up to $12,500 per spouse of qualified overtime pay. So rather than call it the no tax on overtime, from here on out I'll refer to it as the overtime deduction. Overtime pay is defined as the overtime premium over your regular pay rate. For example, if your hourly wage is $20 per hour and your overtime rate is $30 per hour, only the $10 an hour additional premium pay is eligible for the overtime deduction. Other pay premiums, such as shift differentials or Sunday or holiday premiums, are not considered to be eligible overtime. If you receive overtime pay, it will still be included in Box 1 of your W-2 and will still be subject to Social Security and Medicare tax withholding. For 2025, your qualified overtime pay will be shown in Box 14 of your W-2. Starting in 2026, any qualified overtime pay you receive will be shown in Box 12 of your W-2 with the code TT. And depending on how your state calculates taxable income, your overtime pay may still be subject to state income tax. If your adjusted gross income is over $150,000 or $300,000 for joint filers, the deduction is reduced by $100 for every $1,000 your AGI exceeds the threshold. To claim the deduction, you and your spouse must have Social Security numbers that are valid for work. Both spouses on a jointly filed return can each claim up to $12,500 in qualified overtime, bringing the total deduction to as much as $25,000. And the deduction is not available to married persons who file separately. The deduction is limited to your taxable income after subtracting your standard deduction or itemized deductions. It cannot reduce your taxable income below zero. Example: Linney works as a sales clerk at the Unique Boutique. She earned $25,350 in 2025, including $2,275 in overtime. Linney files as head of household. She has no other income. Her adjusted gross income is $25,350, and her standard deduction of $23,625 is subtracted from that to arrive at $1,725. Her overtime deduction is limited to that $1,725, bringing her taxable income to zero. The good news is that for people like Linney, the overtime deduction does not affect her earned income nor her adjusted gross income, so it will not affect any earned income credit or additional child tax credit she might qualify for. So now that we know how this new deduction works, how is it reported on a tax return? I'd like to introduce you to Schedule 1A, Additional Deductions. This form is where all the new deductions created by the OBBBA are calculated. Part 1 of the schedule must be filled out by everyone who claims a deduction on this form. This is your modified adjusted gross income. Unless you are excluding income from Puerto Rico or other foreign earned income, the amount on line 3 should be the same as on line 1. The overtime deduction is calculated in Part 3. You report your overtime from various sources on line 14. Line 15 applies the $12,500 limit, and lines 16 through 20 applied the modified adjusted gross income limit described earlier. When line 20 is subtracted from line 7, you have your qualified overtime deduction. This deduction, combined with any other Schedule 1A deductions, are totaled on line 38 of Schedule 1A, and that amount shows up on line 13B of the 2025 Form 1040. So to show an example of how all this works, let's look at Rodney. Rodney is an aircraft mechanic for the G.L. Ferguson airline who files as single. In 2025, he earned $165,850, including $17,650 in overtime. Since Rodney has no other income, his wage income is the same as his total income is the same as his adjusted gross income, so he enters $165,850 on lines 1 and 3 in Part 1 of Schedule 1A. The $17,650 in qualified overtime is entered on lines 14A and 14C. Since $12,500 is less than $17,650, he then enters $12,500 on line 15. The adjusted gross income from line 3 is then entered on line 16. From that amount, he subtracts $150,000, resulting in $15,850. This number is divided by 1,000, resulting in 15.85. This number is rounded down to 15 and entered on line 19. The amount from line 19 is then multiplied by $100, resulting in $1,500. This is then subtracted from the $12,500 from line 15, and the result of that subtraction, $11,000, is his qualified overtime deduction. The deduction is also limited to his adjusted gross income of $165,800, less his standard deduction of $15,750. This figure exceeds the $11,000 deduction, so he enters that amount combined with any other deductions from Schedule 1A he may have on line 38 of Schedule 1A and on line 13B of his 2025 Form 1040. Rodney has a 24% marginal tax rate, so applying that rate to his $11,000 deduction gives Rodney a $2,640 tax savings. For now, this is all based on draft regulations and forms, which may change before the end of 2025. Additional developments will be noted in pinned comments and the video description, where you will also find links to additional resources and information. If you found this video informative, please give it a like and share it with anyone who could find it useful. Subscribe to the channel to see more oversimplifications of our increasingly overcomplicated tax system. And of course, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.